Hello and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 8669-733-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. During our show today, we're going to discuss the potential drawbacks of both life insurance and Roth IRAs and whether one, both, or neither would be a good fit for your financial strategy. Without further ado, we'll frame today's conversation around a recent U.S. News and World Report article, Life Insurance versus Roth IRA, which offers better retirement security. Planning for retirement isn't always straightforward, and let's be honest, it can feel overwhelming at times. A lot of people spend years fine-tuning their investment mix with the right balance of stocks, bonds, cash, but one thing that often gets overlooked is where those assets are held from a tax standpoint. Believe it or not, taxes in retirement can end up costing more than healthcare. That's why I sometimes call them the silent budget buster. Withdrawals from certain accounts can trigger income or capital gains taxes, and if you're not careful, they could even push your income high enough to raise your Medicare premiums. So, having a tax-free income stream in retirement can provide you with the income you need to enjoy your ideal retirement. Roth IRAs are a popular option, but another strategy many people don't think about is life insurance, which can also offer tax-free income in retirement. Each has its pros and cons, and choosing the right one for you depends on your goals. Many financial services professionals agree, though, that for a lot of people, one option may be the better place to start. Let's take a moment to break down one of the most popular tools for building tax-free income in retirement, the Roth IRA. At its core, a Roth IRA is a retirement savings account that you fund with money you've already paid taxes on. From there, you can invest those dollars. And here's the potential big win. When you retire, both your original contributions and the earnings can come out completely tax-free. Now, there are a few rules to keep in mind. In 2025, if you're under age 50, you can contribute up to $7,000 a year. If you're 50 or older, you get to put in a little more, up to $8,000. But not everyone qualifies, and there are income limits. If you're single and earn more than $165,000 or married filing jointly with income over $246,000, you may not be eligible to contribute directly to a Roth IRA. And there's one more important age milestone to remember, 59 and a half. That's when you can begin taking tax-free qualified withdrawals from a Roth IRA. But keep in mind the 5-year rule. Your account must also have been open for at least 5 tax years. If you take money out before age 59 and a half or before meeting the 5-year requirement, you may owe income taxes and possibly a 10% penalty unless you qualify for an exception. That said, there is some flexibility, especially when it comes to accessing the money you've put in. One of the nice things about Roth IRAs is that you can always take out the amount you've contributed, tax and penalty free. So if you put in $7,000 and the account grows to $15,000, you can still access that original $7,000 without any tax consequences because you already paid taxes on those dollars. All right, let's talk about using life insurance, a retirement income strategy that often flies under the radar. Now, most people think of life insurance as a way to support loved ones after they're gone. And that's true, it's a powerful legacy tool, but it can also play a surprising role during retirement. For example, some policies let you tap into benefits early if you're dealing with a chronic illness or need long-term care. Others are used specifically to create an inheritance, which may free you up to spend down your other retirement assets with less worry. And here's where it gets even more interesting. If you own a permanent life insurance policy with cash value, it can potentially become a source of tax-advantaged income in retirement. Not all policies work this way, so it's important to know what you have or what you're considering. One option that some financial services professionals favor is variable universal life insurance. It lets you invest in things like stocks and bonds, just like with a Roth IRA. Of course, that comes with market risk, so it's not for everyone. Other financial services professionals lean toward whole life policies, which may also offer growth and with some offering dividends. Either way, the potential tax benefits are appealing. Depending on how you access the funds, that cash value can grow tax-deferred or even come out tax-free. The article next describes how you may be able to create retirement income using life insurance. Let's talk about how life insurance can actually be used to generate retirement income, because this isn't your traditional just-in-case strategy. Typically, if someone's using life insurance this way, they're taking out loans against the cash value of a permanent life insurance policy. These loans usually don't need to be repaid during your lifetime. Instead, the outstanding balance is simply deducted from the death benefit when the policy pays out. Whatever's left after the loan is settled goes to your heirs. Now, that might sound pretty straightforward, but there are a few important pieces to understand before using this strategy. First, this kind of approach isn't for everyone. If you're in a low tax bracket now and expect to stay there in retirement, life insurance might not be the most efficient route. And to make this strategy really work, you've got to start early because it takes time for the cash value to grow. Even after 10 years, many people find the cash value hasn't grown much more than what they've paid in premiums. That can feel frustrating, especially when you factor in fees. To get the most income out of one of these policies, you also have to actively manage the death benefit, and that's a step a lot of people overlook. You want a policy that's built to be lean and efficient. With a variable universal life, VUL policy for example, there are two parts, investments and insurance. The goal is to minimize the cost of the insurance portion so you don't eat up your growth with unnecessary charges. But you also need to be careful not to violate IRS rules. There are regulations that govern how premiums, cash value, and death benefits must be balanced. If you cross certain thresholds, your policy could be reclassified as a modified endowment contract, or MEC, and that means the gains could lose their tax advantage status. So, when we're looking at options for generating retirement income, one question that often comes up is, should I start with a Roth IRA or look into life insurance? In many cases, the article explains that financial services professionals suggest starting with a Roth IRA. It's straightforward, flexible, and typically low on fees. Plus, it's easier than ever to open and manage one through a major online brokerage platform. If your goal is tax-free retirement income, a Roth IRA is a smart and accessible first step. Now, life insurance can also be a powerful retirement income strategy, especially for high-income earners who've already maxed out their Roth or aren't eligible to contribute because of income limits. One potential perk of using life insurance is that you don't have to wait until 59 and a half to access the funds, but the trade-off is that life insurance strategies can be more complex and expensive to set up and maintain. That's why some financial professionals don't necessarily see it as either or. Roth IRAs and permanent life insurance can actually complement each other. It all depends on your overall financial picture, your income, and what kind of flexibility you want in retirement. If you have any questions about the new generation retirement system, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.